Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now let's start by talking about inflation. As many of you may have already read, US inflation for June did not peak and instead rose much further from last month's release to 9.1% year on year, thereby marking yet another 40-year high. Now, there are several details of the inflation report that we'd argue are worth your attention. First, energy prices continued to be one of the more significant contributors to the inflation report, as did food prices. However, there were signs that inflation was increasingly broad-based, with gains in services inflation and shelter costs starting to rise more rapidly. There were also no silver linings in the details. Month-on-month inflation accelerated in June, not only at a headline level, but also at the core level that strips out the supply-led impact of food and energy inflation. Finally, the inflation number itself was not only higher than consensus expectations, but it was higher than all the range of forecasts around that consensus. Now, for investors, the market reaction was arguably even more interesting. Much of the market reaction was focused on bond markets, so the shorter-term bond yield, like the 2-year yield, did move sharply higher, driven in turn by a jump in Fed policy rate expectations, with markets now moving to price in a significant probability of a 100 basis point rate hike at the next policy meeting later this month. Now, longer-term 10-year bond yields, though, fell as rising rate expectations were more than offset by worries that tighter policy makes an economic recession more likely. The combination of these moves meant that the 10-2 yield curve, which is one key indicator in a recession checklist, moved even deeper into negative territory and thereby flashing its own recession warning. Now, the 10-year 3-month yield curve, which is often viewed as a somewhat more timely indicator of recession, still remains positive, but is only 50 basis points away from turning negative itself, which arguably in today's environment could be just one Fed policy meeting away. Elsewhere, of course, equity market weakness and US dollar strength, though, were surprisingly muted, with the S&P 500 falling only modestly. Now, from an investment point of view, this market reaction, the reason we went into those details is because we think it supports two of our directional views. First, rising recession worries do fit well into a second-half view to raise allocation to bonds at the expense of equities, a view we'd clearly be increasingly comfortable with as longer-term bond yields remain capped despite rising Fed rate expectations. Second, yesterday's market move was a good example of why we wouldn't throw the equities baby out with the bathwater. The muted headline index reaction does raise questions on just how much of the recession probability may already be priced in. Having said that, it may be appropriate to start tilting equity allocations towards more defensive sectors, such as healthcare, which you see as preferred in the US. So that's, I think, our key takeaway, of course, from following yesterday's US inflation number. But before we close, I think what's important is amid all of that focus on US inflation and Fed policy, we would not lose sight of two other significant policy events yesterday. We had central banks in both New Zealand and Canada raise policy rates, with the Bank of Canada in particular surprising markets with a 100 basis point rate hike. Now, these policy actions are consistent with our own view that favor commodity currencies because they are supported by their own rate hikes as well. While a surging dollar has admittedly been a headwind against commodity currencies recording significant gains, we remain comfortable using dips to add to commodity currencies, given they are supported, of course, not only by higher commodity prices, but as we noted, they are supported by significant rate hikes of their own. So overall, opportunities in defensive equity sectors like healthcare in the US, data of course being consistent with a longer-term preference to add to bonds, and of course we continue to look for opportunities in commodity currencies. Those are three areas we'll be focusing on for now. But we'll pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening. Wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.